For years, Vodafone's share price has been in decline, frustrating investors and casting doubt on every promised turnaround. But now, optimism is returning. Shares have surged over 20% this year, entering bullish territory for the first time since 2022. What's changed? CEO Margherita Della Valle's bold restructuring plan is finally gaining traction. This isn't a minor tweak, it's a fundamental overhaul, and investors are taking notice. The completed merger with Three UK marks a major milestone, while Vodafone's African fintech operations continue to deliver double-digit growth. Even in Germany, the company's toughest market, the decline in sales is slowing. These improvements have given Vodafone the confidence to reaffirm its financial forecasts, expecting adjusted free cash flow between £2.4 and £2.6 billion. This signals that the turnaround is being backed by real numbers, not just hope. Major investment banks are echoing this optimism, suggesting the foundations for a sustained recovery are finally being laid. Investors are watching closely. Could this be the comeback they've been waiting for? At the heart of Vodafone's revival is CEO Margherita Della Valle's focused strategy. She's streamlined operations, cut jobs, and shifted the company's focus to core markets like Germany, the UK, and Africa. By doubling down on these regions, Vodafone can invest more in network quality and customer service, critical in telecoms. The Three UK merger is a prime example, aiming to create a stronger competitor in Britain. Improving customer experience is now a top priority, with early signs of rising satisfaction. Financial discipline is also key, selling underperforming assets and managing costs to reduce debt. This approach is building a more resilient, agile business. The market sees these steps as credible and necessary for Vodafone's return to growth. The company's transformation is finally moving from talk to action. So, what does Vodafone's turnaround mean for your wallet? As of August 5, 2025, 1,000 shares cost about £835, a manageable entry for many investors. UBS, a major bank, has set a bullish price target of 120p per share. If reached, your investment could grow to £1,200, a 44% return, far outpacing a savings account. Investors are drawn by the potential upside and signs that Vodafone is finally getting its house in order. But remember, analyst forecasts are educated guesses, not guarantees. The path to 120p won't be smooth. Market volatility and company setbacks are always possible. The potential is real, but so are the risks. We'll look at those risks next. Germany is Vodafone's largest and most challenging market. Years of customer losses and weak performance have made it the company's biggest headache. But now, the rate of sales decline is slowing, hinting at progress. Network upgrades, better pricing, and improved customer service are starting to make a difference. The competition remains fierce, and Vodafone's cable network still needs work. Turning things around will require time, investment, and a shift in public perception. Early signs are encouraging, but Germany remains a major uncertainty. Sustainable growth, not just slowing losses, is the real test. Investors will be watching German results closely for proof of a true turnaround. While Europe struggles, Vodafone's African business is a bright spot. Through Vodacom, Vodafone dominates markets like South Africa, Egypt, and Tanzania. M-Pesa, its mobile money service, is a fintech powerhouse, driving double-digit revenue growth. Rising internet and smartphone use across Africa means even more potential ahead. Vodacom's investments in 4G and 5G networks are expanding reach and opening new service opportunities. For investors, Africa is a key reason to believe in Vodafone's future. This growth engine helps balance out the volatility in Europe. The merger with 3UK is a game-changer for Vodafone. The combined company will have the scale to compete with BT, EE and Virgin Media O2, accelerating 5G rollout and improving coverage. Cost savings from merging networks can be reinvested in better service and technology. But integrating two giants is risky. Cultural clashes, IT headaches, and unexpected costs can derail even the best plans. Execution risk is real. Many big mergers have failed to deliver promised benefits. Success would be a huge win for Vodafone, but any major missteps could set back the turnaround. Investors need to watch the integration process closely. The next 2 years will be critical for proving this merger's value. A smooth transition could redefine Vodafone's future in the UK. Despite progress, Vodafone's massive $53 billion debt remains a major concern. Servicing this debt eats into profits and limits investment in new technology and growth. Competitors with healthier balance sheets can outspend Vodafone, putting it at a disadvantage. Management is selling non-core assets and focusing on free cash flow to chip away at the debt. But even with $2.6 billion in free cash flow, reducing the debt mountain will take years. High debt makes Vodafone vulnerable to economic shocks and rising interest rates. For investors, this is the biggest risk. Progress will be slow and patience is required. The financial turnaround will lag behind the operational one. Some may prefer less indebted companies for quicker returns. What do the experts say? UBS is bullish, seeing big upside from the turnaround, 3UK merger, and African growth. But not all analysts agree. Some are more cautious, citing execution risks and slow progress in Germany. Price targets vary, and some recommend waiting for more proof before buying in. The bullish case depends on everything going right: smooth integration, German recovery, and continued African growth. The risks, debt, competition, and execution, are real. Analyst reports are useful, but your own risk tolerance and investment horizon matter most. Decide if you're comfortable with Vodafone's high-stakes story. So, should you buy 1,000 Vodafone shares today? There's no simple answer. It depends on your risk appetite and belief in the turnaround. The case for buying: new leadership, a clear strategy, share price momentum, and a strong African business. If you're optimistic and patient, today's price could be a great entry point. The case for caution: huge debt, complex merger integration, and uncertainty in Germany. A cautious investor may prefer to wait for more concrete results. Investing in Vodafone now is a bet on transformation and long-term recovery. If you're comfortable with risk and can wait, it could pay off. If you want safety and predictability, you might look elsewhere. The choice, as always, is yours.